Now, all this talk about the Fed going to lower interest rates. Well, guess what? Normally, from an economic, and I'm talking macro right now, economic perspective, when the Fed is talking about either staying neutral or lowering rates, the 20-year yield, the 10-year yield, the 30-year yield, you will see that trickle down. It's not happening. Those yields get on the charts and you can look at it. It is not going down. These 30-year yields and 10-year yields on the chart, it's moving up, which is bonkers because the Fed is trying to take control of rates, right, and lower them for various different reasons, right? But it's not happening. Okay, so I think this has something to do with our massive deficit. If look, in conclusion, and I'm going to say one more thing of what we're talking about, our economy is kind of hurting right now. If you look back in 2027, I think we had like a $17 trillion deficit. Today in 2026, it's $30 trillion. The interest on that debt is like $1 trillion a year. If you look at the difference between that, if you do the numbers and you start looking at $1 trillion payment is break even back to 2007, which things weren't great, as we all know, it's a fraction. Okay, it's less than half of what the deficit payment was. And so when the Fed is sitting there trying to lower rates and the yields are still going up, I don't know if this has ever happened before, people. We got serious problems on our hands here. So, you know, the point I'm making with this whole discussion is that you can't have all your money in the stock market right now. If you're an investor, are there people making money in the market? Absolutely. Swing traders who do technical indications to make decisions on when to let their money move in certain areas, on certain companies that have good revenue, they're making money. But when the Federal Reserve isn't able to let the yield, not let the yield, but cause the yield to trickle down, we've got some problem on our hands. And look at those charts. The yields are moving up. It's crazy talk, man. Gosh darn, I don't know how long that audio was out right there. I got to go back. Let me, I might put this thing on here. So anyway, I was getting fired up. If you're still on, okay, very important stuff here. Back in 2007, the deficit was about $17 trillion. Today, we're looking at about $30 trillion. Now, the interest payments today, sorry, I came back right there. I know my mic was glitching out. Should be back. Today, the interest payment is $1 trillion a year, everybody. Now, the Fed's coming in, and the president, wants us to lower the rates. When the Fed is out there talking about wanting to neutralize, stay neutral, or lower rates, and the yields don't go down on the charts, we got problems on our hands, people. Huge problems going on. So if you're interested, get on the charts, look at the yields. You can see that they're still trickling up. You can look. I mean, if you're out here trying to buy a house and lock in a certain rate for a mortgage loan and stuff like that, they keep moving up. It's scary, man. Hey, how's it going, everybody? Graham, thanks for checking in, saying hi. Appreciate that. But so I had to share this with you all just to reiterate and just finish it up here. When the yields are moving up on those charts and the Federal Reserve doesn't have control of how the market moves, our economy, the stock market is a little bit, it's sensitive because the dollar is also moving down. Okay, we also have, if you look at the charts on the US dollar, we're losing value. It's just kind of scary, man. I just want to share that with you guys. Appreciate you checking. Give me that like and the thumbs up if you would, please. One day at a time. I'm just going to share stuff as I learn it, and just hang in there. Don't put all your money in the stock market right now. People are making money, of course, swing traders and stuff like that, but don't put all your money in the market at the moment. All right, thanks for checking in, man. But peace out. Peace out.